Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video, I'm going to talk about something that I probably should have did a video on this maybe way back when I first started the channel, but I'm doing it now. And I'm going to talk about how to set up an option collar the standard way. The way I do it with my money is I like to buy LEAP put options that expire in like 2 years or as long as I can, and then sell to open monthly call options because of the time advantage. But that's not the standard setup. The standard setup is very simple, and I thought it'd be a good idea to explain the basic setup of an option collar so that you could see it's really simple, especially if you're new to options, and you can build on something that you probably already know how to do, which is buying and selling stock as an investor. So when you set up an option collar, the first thing you do is the same thing that you do as an investor. You pick a stock and you buy shares of that company. And I think Barchart is a very good website. And let's go ahead and find a stock on Barchart, barchart.com. And so we go to Barchart and then we click on the options because we are going to do an option collar. And then we go to most active options because those are kind of stocks that you want to trade. You want to trade stocks that are highly liquid and high volume. So here's the list right here, and it goes in order. So at the top of the list at 328,079 shares is Apple. Below that comes Tesla, and then Alibaba, AMD, Bank of America, NIO. I've never even heard of that one. And you can just go on and on down the list until you find a stock that suits your fancy. And then let's go ahead and look at Apple since they're at the top there. And so let's go back to the platform. You should have a platform with an online broker, E-Trade, Ameritrade, Interactive Brokers, or one of them. And let's go ahead and look at Apple. So let's bring up Apple. And the first thing you're going to do is you're going to buy 100 shares of this stock. Or if you want, you could buy 200 shares or 300 shares as long as it's in multiple of 100 shares. And so let's go ahead and do that. We'll click on the buy button like this and put in 100 for quantity. And then we click the review order button like that. And there it is right there. It's going to cost you $17,834, and the bid is $178.29. The ask is $178.34, so it's giving you the ask. I just put in for a market order, and then you click the place order, and if the order fills, you'd be the proud owner of 100 shares of Apple, and your investment would be $17,834, which is the same thing you do if you just invest like a regular investor. So now you got the 100 shares, and now you're going to go on to step number 2. So step number 2 is you are going to sell to open a call option, which is a covered call. So you click on the option chain, and you're going to pick an option that you are going to try to make that much money in that much time. And so let's go ahead and look at options about 6 months out, and that'd be this one right here. And let's look at some out of the money call options, and let's see what we come up with here. So we bought the 100 shares, and now we're going to look. Let's say we go up 10%. So Apple is at 178.97, so 10% would be, let's see, 10% of 180 is 18, so let's go up to a $200 strike price. So here it is right here, and the bid is $490, the ask is $505, so let's say you get about $500 for that. And so you're going to sell to open this call option, and you're going to be compensated for that transaction. So you click the sell button like this, and then you click sell to open, and you bought 100 shares, so you're going to sell to open one contract. If you bought 200 shares, you put a 2. If you bought 300 shares, you put a 3. You always get the same number of options per 100 shares. That's the basic setup. And let's try to get $500 for it. So put in the 5 for the price, click review order, and then there it is right there. If the order fills, you click place order. If the order fills, you'd be the proud owner of one short call option. And then you move on to step number 3. Okay, step number 3 is you're going to take that $500 that immediately gets credited to your account the moment that the order fills, and you're going to look for a put option for $500 or less. So let's go ahead and look at some out of the money put options, and you're going to do the same expiration date. That's the standard setup. If you want, you can pick different expirations, but that just means you're tweaking it, and there's nothing wrong with that, but I'm just showing you the basic setup here. So let's look for a put option that is $500 or less, and it looks like the 155 put, the bid is $430, the ask is $450. So let's say $440. So you're going to click on that put option right there, and you're going to buy to open the put. So we sold to open the $200 call, and we're going to buy to open a 155 put because the bid is $430, the ask is $450. And so let's go ahead and do that. And so you got $500 of spending money by selling to open that covered call. So you click the buy to open, and you put in one contract. Because you got 100 shares, you sold open call, and let's try to get it for $440. Click the review order button right there, and if it looks good to you, then you're going to place the order, and if the order fills, then you are going to be the proud owner of one put option, strike price $155. And what does that mean? That means that because you own the put option, you, if you wish, have the right to sell Apple at $155 a share. So if there's a recession and Apple goes down to $100 a share, well, guess what? You have a put option, and you can sell Apple for $155 a share, and then you can buy it back for $100 a share. That's the whole point of these option callers, is that it's a way of buying put on. It's almost like buying insurance, right? Now, if you want to, you can just buy the stock and, you know, just hold it and just ride through the storm and hope it comes back. But why do that when you can set up an option caller like this? And so I put all the numbers here in PowerPoint. So here's the numbers right here. Number 1 is you have 100 shares of Apple and you spent $17,834. And then number 2 is you have a $200 call option. It expires on October 18, 2019. Today is May 27th. 2019, so that's 144 days, and I put short here because you are short the call, and you got $500 for that. And then you took that $500 and you spent it on this $155 put, which expires same day in October 18, 2019, and I put long. And you spent $440, which leaves you $60 extra, which just goes into your cash account. So you're making a $60 credit. Now, what does that all that mean? It means that your risk is limited and your profit is limited. So your maximum risk is the $2,334 minus 60 for a total of $2,274. How did I come up with that number? It's very simple, okay? Apple was at $178 a share and some change. So you take that $178 and if Apple goes down to $155, that's a loss, right? If it goes down to $150, well, you don't lose any more money because your put option will be worth $500 on the 18th of October. If it goes down to $100, then your put option is going to be worth $5,500 because a put option, and that's called intrinsic value. A put option gives you the right to sell your stock at that set price, which is $155. So if Apple goes to $155, then you do take that loss. But if it goes any lower than that, you don't lose any more money. And you spent $444 for that privilege, but that's why you sold to open this call option, because the call option gives you money to buy this put option. That's the way that these option callers work, the basic standard setup. And of course, if you want, you can mix it up like I do. If you watch my previous videos, you know I like to buy long-term puts and sell short-term calls. And then you would need extra money. But that's a whole different story. This is just a basic setup where you buy 100 shares or 200 shares, whatever. In this case, 100 shares, and then you sell the open one call option, and you get money for that. And then you take that money, and then you buy the put option, and you want to make sure the put option is less money than what you got for the covered call. Okay, so because you bought Apple at $178 a share and some change, 34 cents, then Apple could go down to 155 in the next 144 days, in the next 6 months or so, right? And if it does, then 178 minus 155 equals $2,334. That's the most money you can lose. 17,800. You own 100 shares, right? And 178 minus 155 is $23 a share, extra $34. So that's where it all comes from. Every dollar it goes down, you lose $100 until it hits 155, and then your put option kicks into high gear. And if it goes down to 154, you do lose another $100 in your shares, but you gain $100 in your put. If it goes down to 153, your put's worth $200, and so it all cancels out and equalizes. That's how put options protect you, right? So you could lose the $2,334, but this $60 comes from this gap here, okay? You sold a call, you got $500 for that, and then you took that $500 and you bought a put for $440. That leaves you $60. And of course, I didn't include commission there. You are going to lose that. But I'm just going by prices of the options in the stock. So you got that $60. So your total risk is $2,274 in the next 144 days. Now, how much money could you make? Well, if Apple goes up to $200, you make that money. Okay, so you bought Apple at $178.34, and so 200 minus 178, that's a possible $22 or whatever. Actually, $21.66, and then I added the credit, and so you could make a possible $2,226 on your $17,834 investment. If it goes any higher than that, then your profit gets capped. You don't make any more money. Reason being is because if, let's say, Apple goes to 205, well, unfortunately you own a short call option, which means somebody else has the right to buy Apple at $200 a share from you. So if Apple goes to 205, then that person could buy Apple at $200, and you are obligated to sell that by the contract at $200 a share, even though it's worth $205. So you take that $5 loss in the call, right? Now you do own 100 shares of Apple, so Apple is worth $205, but the call is worth $205, and you're short the call. And so, unfortunately, and you might think, well, golly gee, I sure wish I didn't sell to open this call. But the whole point of the option caller is you're kind of drawing a line in the sand. You're saying, okay, I'm going to try to make $2,226, which is better than 10% return. So it's like what, 178. 10% return would be $1,783, right? That would be 10%. Oops. Let me take that back there. 1,783, right? And so that's like that's like about a 14% return. So you're gunning for a 14% return in the next 144 days, and you're willing to risk this much money to do it. So worst case scenario is you could lose this money if Apple goes below $155 a share. But you could also make this money if Apple goes up to $200 a share. So when you pick a stock, right, the same rules apply, right? Whether you use this website or whatever screener or website you use to find a stock, maybe you just read the news and you pick a stock, the same rules apply. You're going to try to pick a company that you feel good about, maybe a low PE ratio, or maybe it's a stock that's been doing well. However you choose your stock, the same rules apply. You're not going to put all your eggs in one basket, right? You're going to diversify. You're going to dollar cost average. But by doing these option callers, it cuts down your risk dramatically. And instead of just flat out buying 100 shares of Apple, and then if Apple goes to $100 a share and you don't have this put option, then you lose a heck of a lot more money. You're going to be down like what, $7,800. I mean, it's way better to lose $2,274 than it is to lose $7,830, right? If it goes down to $100 a share. You know, I mean, there is a trade war going on with the tariffs in China. I mean, who the heck knows why the stock market could drop, right? So this is how the standard option collar works, and you could pick any stock you want. Tesla. Let's look at Tesla real quick, and then we'll call it a day. So let's click Tesla. That's the number 2 high volume stock, and it's trading at $190.63 a share. And boy, oh boy, I mean, if we look at the chart here, I already know that that Tesla has been taking a beating, right? So look at this chart here. It looks like in the last few months, it was a $350 stock, and now it's all the way down to $190. So I think if you're going to buy Tesla, an option collar is a pretty good idea. If you think maybe Tesla will recover and it'll come back up. So let's look at some Tesla options, and again, we'll look at some 144 days out, 6 months out, and let's look at out of the money, and let's use the same rule. Let's look at options that call options that are the 10% out of the money. Let's say you're going for a 10% out of the money. So Tesla 190. So 190 plus 19 would be 219. So let's look at the $220 strike prices, and there you go. If you wanted to, you could buy 100 shares of Tesla, and it would cost you $19,000, and then you would sell to open a 220 call. The bid is 1760, ask is 1820. So you want to find a put option cheaper than that. And so if we look at options that are cheaper than that, it looks like the $160 put fits the bill. So you could sell a 220 call, and then you could buy to open a 160 put, or if you wanted to make a little credit, you could pick the same one as Apple. You could pick a 155, and the bid is 1625. The ask is 1665. So let's say 1650, and let's say on the call you get $1,800. So that's a $150 credit. And then if Tesla, if all those orders filled, you bought the 100 shares, you sold to open the 220 call, and you bought to open the 155 put. If all those orders filled, then let's say Tesla went up to 220, you could make, it almost works out the same as Apple. Tesla is at 190. If it went up to 220, that's, let's see, 200, 210, 220, that's $3,000. Actually, that's even better, right? But it looks like the max loss is a little more too. So if Tesla did go down to 155, you'd lose the $4,500. But no, that's actually $3,500. So you could take a $3,500 loss, right? That's $350 or 350 points or whatever. Or I'm sorry, 35 points. And since you have 100 shares, that'd be $3,500. And so you could lose that $3,500, but you did have that credit, right? Which was a $150 credit. So you could lose $3,350, but you could make $3,000, right? And so the option collar works just fine on Tesla as well. Now, if Tesla goes lower than 155, you're not going to lose any more money. If Tesla goes all the way down to 100, you will lose that 3,300 whatever dollars. But if Tesla rebounds and goes up to $220, then you're going to have a nice payday in the next 144 days or 6 months. So that's it for this video. That's how the option collar works. That's the standard setup. And once you get the hang of that, you can always kind of tweak things a little bit. You can choose different expirations and try to make money off of the theta. Or you can do short-term options. You know, you could buy Tesla right now at 190, and then you could sell 195 in 25 days. And I can't even believe that you get $1,200 for a 195 call, and then you could take that and buy a 185 put, And then in the next 25 days, it looks like your max risk would be about $500 minus the credit, and the credit would be about 50 bucks. So you could lose about $450. But if Tesla went up to 195, you can make $500 plus the credit. So you can make about $550. You could lose about $450 or whatever. So you can play around with it, whatever time frames. You can do short terms, you can do long terms, however you want to do it. The option caller is a great way to invest. It's simple, easy to learn, and it'll kind of help you get the hang of how stock options work in general. So that's it for this video. Thank you for watching as always. If you have any comments or feedback, I appreciate any support you can give me. Like button, subscriptions, whatever you feel like doing. Thank you for watching, and until the next video, have a good day and have a happy Memorial Day, everybody.